In 1930, two men stood in line outside the same bank in New York. Both had saved their entire lives. Both had around $12,000 in deposits, the equivalent of over $200,000 today. The first man panicked. He withdrew everything in cash the moment rumors of bank failures began spreading. He held onto it, waiting for certainty. The second man did something different. He left his money in place, but more importantly, he quietly started buying shares in companies that had just lost 70 to 80% of their value: railroads, steel, oil. For the next 3 years, both men watched the same headlines: banks collapsing, unemployment rising past 20%, the market falling nearly 90%. By 1933, the first man still had his cash, but its purchasing power had eroded. Opportunities had passed. The second man. By 1940, his investments had multiplied several times over. Same crisis, same starting point, completely different outcomes. What happened here was not random. It wasn't luck, and it wasn't simply about being brave or fearful. It was part of a repeating pattern, one that has appeared after every major economic crisis across the last century. A pattern that quietly determines who loses wealth and who absorbs it. What most people miss is this: crises don't just destroy wealth, they transfer it. I call it the century reset cycle, a slow-moving system that unfolds roughly every 80 to 100 years, not exactly on schedule, but close enough to leave a trace across history. This cycle doesn't begin with a crash. It begins with decades of stability, followed by excess, then distortion, and finally, correction. And after the correction, a reset, a redistribution of assets, power, and opportunity. This is where it gets important. The reset doesn't reward effort, it rewards positioning. The century reset cycle unfolds in 5 distinct phases, each one driven not just by economics, but by human behavior. Phase 1: Stability and expansion. After a major crisis, systems are rebuilt. Regulations tighten, debt levels are low. Trust in institutions is slowly restored. Economic growth begins, not explosively, but steadily. People are cautious, they save more, they avoid speculation. This is typically the healthiest phase of the cycle. Cause to effect: low debt to sustainable growth to rising confidence, but over time, stability creates complacency. Phase 2: Excess and leverage. As memories of the last crisis fade, behavior changes, risk becomes normalized, debt increases, credit expands, financial instruments become more complex. People stop asking, "Can this fail?" and start assuming, "This always works." The data shows that before nearly every major crisis, leverage reaches historic highs, not just among individuals, but across corporations, banks, and governments. Cause to effect: easy money to rising asset prices to increased borrowing to inflated valuations. This phase feels like prosperity, but it is built on fragility. Phase 3: Distortion and fragility. At this point, the system becomes unstable. Asset prices detach from reality. Housing, stocks, or commodities begin trading far above intrinsic value. Inequality widens. A small group accumulates disproportionate gains. Meanwhile, the majority begins to rely more heavily on debt just to maintain their lifestyle. What most people miss is this: the system doesn't collapse because of one event. It collapses because it has already become fragile. Cause to effect: overvaluation plus high leverage to system vulnerability to sensitivity to shocks. All it takes now is a trigger. Phase 4: Crisis and collapse. The trigger arrives. Sometimes it's a banking failure, sometimes a market crash, sometimes a global event. But the result is always similar: liquidity disappears, asset prices fall sharply, fear spreads faster than logic. The data shows that during major crises, stock markets often fall 50 to 90%. Unemployment spikes rapidly, credit markets freeze. People sell not because they want to, but because they have to. This is where the transfer begins: same asset, different outcome. Phase 5: Reset and transfer. This is the least understood phase and the most important. After the collapse, assets don't disappear, they change hands. Those who are overleveraged are forced to sell. Those with liquidity or access to it begin to accumulate. Governments intervene, policies shift, new systems are introduced. The foundation for the next cycle is quietly laid, cause to effect, forced selling to asset undervaluation to strategic accumulation to long-term wealth creation. This phase doesn't feel like opportunity, it feels like uncertainty, which is exactly why most people miss it. This pattern is not theoretical, it has repeated itself with remarkable consistency. 1929, the Great Depression. Before the crash, margin debt surged to unprecedented levels. Investors were borrowing heavily to buy stocks. When the market collapsed, the Dow Jones fell nearly 89% from peak to bottom. Banks failed in waves. Over 9,000 banks closed in the United States alone. Unemployment reached 25%. But here's what most people miss. By the late 1930s and early 1940s, those who had capital began acquiring assets at extreme discounts. Entire industries were restructured. Wealth didn't vanish, it shifted. 2008, the global financial crisis. Before 2008, housing prices had been rising for nearly a decade. Debt expanded rapidly. Mortgage-backed securities masked underlying risk. When the system broke, the S&P 500 fell about 57%. Major financial institutions collapsed or were bailed out. Trillions of dollars in value disappeared. But again, the pattern held. Large institutions and investors with liquidity acquired distressed assets. Real estate portfolios, equity stakes, entire companies. By 2013, markets had largely recovered. By 2020, many assets had reached new highs. Same crisis, different outcomes. 2020, the global shock. The 2020 crisis unfolded faster than any in modern history. Markets dropped over 30% in a matter of weeks. Unemployment spiked sharply. Entire industries shut down. But what followed was even more revealing. Massive monetary intervention, interest rates near zero, liquidity flooding the system. Asset prices rebounded rapidly and then surged. By 2021, stock markets hit all-time highs. Real estate prices soared. The gap between asset owners and non-owners widened further. What most people miss, the reset happened faster, but the transfers still occurred. Right now, we are not at the beginning of the cycle, and we are not fully through it either. We are somewhere between Phase 3 and Phase 4. Signs of distortion are visible: elevated asset valuations, high global debt levels, increasing financial instability. At the same time, early signs of stress are appearing: tightening liquidity, volatility in markets, shifting monetary policies. This is where it gets important. Most people are still thinking in terms of short-term events, but the century reset cycle operates on a different timeline. It doesn't react, it unfolds. If this pattern holds, and historically it has, there are a few key signals that tend to appear before the next phase becomes clear. 1. Credit tightening. Watch lending conditions. When banks become more restrictive, liquidity begins to dry up. This often precedes broader market stress. 2. Asset price divergence. Pay attention to the gap between asset prices and underlying economic fundamentals. When valuations remain high despite slowing growth, instability increases. 3. Forced selling events. These can appear as sudden market drops, institutional failures, liquidity crises. They are often the first visible signs of the transfer phase beginning. 4. Policy shifts. Major changes in interest rates, stimulus programs, or regulatory frameworks often signal that the system is entering a reset phase. These are not predictions, they are recurring indicators. The data shows they tend to appear before the shift becomes obvious. Now return to the two
Don't
men
worry,
in
Raj.
1930.
Updating your passports
The
is
first
quick
man
and
wasn't
easy now.
irrational. He acted
Really?
based on fear
I thought it
and
would take
uncertainty.
hours.
He preserved what he had. But he missed what was happening beneath the surface. The second man didn't predict the future. He recognized the pattern. He understood that crises change pricing, not value, and that timing is often less important than positioning. Years later, one still had cash, the other had assets. Same starting point, different understanding, different outcome. What history shows is not complicated, but it is uncomfortable. Economic crises are not just disruptions, they are transitions. They reset systems, they reprice assets, and they redistribute wealth. What most people focus on is the collapse. What they miss is what comes after. The century reset cycle does not reward reaction, it rewards awareness. A quiet understanding of how systems move beneath the noise. If this gave you a new framework for thinking about economic cycles, then you're already seeing what most people don't.